Hey everyone, I'm so excited about today's episode, but first want to let you know that this show is made possible by Fortune Builders. I also want to take a minute to invite you guys to an amazing opportunity to learn from some of the top experts in the real estate industry about how to get started in real estate or scale an existing business to the next level. Fortune Builders is hosting a one-day webinar to help you learn about real estate investing in today's market. So throughout the show, if you feel like you're ready to get started, go to FortuneBuildersShow.com to register. Again, that's FortuneBuildersShow.com to register. If you're watching on YouTube or Facebook, you'll find a link right below the show so you can get there that way as well. And please remember that the content of this show and every show is for educational purposes only. Myself or our guests are not going to be providing any legal, financial, or professional advice. If we share specific results, they are attributed to an individual or a business, and we can't guarantee the results will happen for you, those earnings or the income will match those figures. The bottom line is there's always risk when investing in real estate. You can make a lot of money or you can lose a lot of money, and it's hard work. But that doesn't mean we can't have fun doing it. So let's get into today's episode.
From a team that has $1 billion in real estate investment experience. A show to help you learn the strategies and systems it takes to get started investing in real estate. This is the Fortune Builders Real Estate Investing Show.
All right, welcome everyone. Paul Shively here, your host of the Fortune Builders Real Estate Investing Show. Happy to have you back with us. I want to welcome each and every one of you, whether it's your first time joining us for the show or whether it's your 10th, 20th, 30th time. We're super happy to have you here. As I mentioned, Paul Shively here hosting today's show, and we have a special guest. We have Gregg Cohen, one of the premier, dare I say, one of the top real estate investors in the entire country on the single family rental side of the game, actually coming here, taking time out of his busy day to help teach us, train us, educate us. So Gregg, thank you so much for showing up today. We're happy to have you.
Paul, it is an absolute pleasure to be with you, brother. Happy to be here with the audience and hoping to create a lot of value for us here today.
Amen. Amen. And if you notice today's show, maybe a little bit more laid back. Gregg and I have been doing this for about actually over a decade now together. So we're super comfortable with each other. We tend to get very familiar with each other, which is super fun. So you're in for an awesome show today. What we're going to be talking about today, 500-foot level, is the 5 profit centers of real estate and how you can take advantage of them. And that actually brings us to our term of the week, right? Which is profit center. Right. And so, Gregg, in your definition, real quick, give us a 30-second definition in your world of what does profit center mean?
Well, profit center should be the reason why you choose to invest in rental properties over your other options, whether that's the stock market, whether that's bonds, whether that's crypto or whatever asset class you're investing in. You know, the profit centers are the reason to be doing this. So we have to have a complete understanding of how many and what profit centers are in your investments, and then you can compare for the best use of your dollars.
Absolutely. Right. So profit centers are absolutely key for you, Gregg, for me, for every single one of you at home listening to this, watching this. It's important for you to understand. And I always taught that there were 4 profit centers. So I'm actually going to get educated today because Gregg's going to teach us that there's actually 5 profit centers. So I'm super excited for today. Gregg, thanks for showing up to the Fortune Builders Real Estate Investing Show. We're super happy to have you. So let's dive in. Let's get right into it. So Gregg Cohen, give us a 2-minute background for those of you who may not be as familiar with you as I am, or 10 years of working together. Walk us through your journey for a couple minutes, if you don't mind. Educate us on what your business does. And kind of your track record a little bit, and then let's dive in after that.
Absolutely. Well, sitting here now with you investing in real estate for over 17 years was not how it was all drawn up to be for my career and my investing journey. I went to the University of Florida. I graduated. My thoughts and my career path was focused on corporate America. And so I got a good job there and I was all proud and excited until I actually got there and realized that it was just not for me. And, during that tough time of really just kind of having to do a deep dive on what I valued as far as a career and what I valued as far as an opportunity for me to create a lifestyle for myself and my family, I happened across a great book that I hope everybody listening to this podcast has listened to or has read, and that's Rich Dad Poor Dad. That book
Such a good one.
yeah, it started a chain reaction for me that has changed my life, and it all started there. So I read that book. It motivated me, who, if you knew me or if you know me now, right, I am a conservative fella, and especially before I read that book, I was a really conservative fella. Listen, I was going to college and I was going to get a job in corporate America. That's just what conservative people do, right? But this book helped me understand the power of an asset that could create income for me in the future, that would allow me to make decisions with my time that I could do what I wanted to do. And so I came away from that book obsessed with this idea of creating an army of income producing assets. And so that's what I set out to do. Again, I decided to quit my job. I decided to grab my best friend, Alex Afakis, who is one of my business partners today. And we started off on this venture here of educating ourselves, learning about investing in rental properties. I am so grateful that led me to FortuneBuilders. Although this was before there was even a FortuneBuilders. I got to meet Than, Paul, Conrad, the whole team there, back when they were just flipping hundreds of houses a year and they were looking for people to teach. They hadn't actually built their education business yet, but I was there. I was at a conference and I walked up to Than and I said, "Hey man, I want to build a business just like yours. Will you teach me?" And that started a very special relationship that now me and Shively and the whole gang over there, we're going on close to 2 decades of what started out as mentorship and has now become true partnership and just true alignment for both of our companies. JWB is my company, JWB Real Estate Capital. And that was built after the idea that once we figured out how to invest in rental properties for ourselves, we wanted to create an experience to help everyday people out there invest in single family rental properties as well. Because as we'll talk about these 5 profit centers here in just a minute, investing in single family rental properties gives you the ability to earn better upside with less risk than your other investing options out there. And we just felt that there's a real place in the investment portfolios of Americans and for those who want to invest in an asset class that can create peace of mind. And so we set out to do that, and we're now 17 years in business. We've been blessed to serve over 1,300 clients. We manage over 4,800 properties here in Jacksonville, Florida. We were just blessed to win the 2022 Entrepreneur of the Year Award, which was given to us by Ernst & Young for the state of Florida, which we're just super, super proud to have that as a team award. We are an 11-time winner of the Inc. 500 fastest growing companies. We've won best places to work here in Jacksonville for 8 times. And, our whole investing model is built on the strength of our team, because what not a lot of people realize is that it's really easy to put numbers on paper to sell properties or things like that. But the team is actually what takes those estimated returns on paper and turns that into reality and better performance for our investors. And so we're just lucky. We have an incredibly talented team here, about 100 individuals in our office here in Jacksonville. And we just wake up every day trying to make the experience as great as possible for those investors out there that want to be in single family rental properties.
Amen, man. We're super happy to have you. I can say with absolute clarity, one of the best business partners and partnerships I've ever had in my entire life. And so super happy to have you on, man. Thanks for sharing. And in case you guys didn't kind of catch all that at home, Gregg is the epitome of basically real estate royalty right here on the rental side of the game. So we're super lucky to have you. And I'm going to test everything you said, right? And I love the fact that you mentioned the team, love the fact that you mentioned this isn't, we're not out here to, be this giant institution. It's a team. We're helping individuals, right? That's what the show's all about. That's what your company is all about. And actually sneak peek, that's what I'm going to be talking about actually at Real Estate Ignite this year. So little sneak peek and shameless plug for Real Estate Ignite, right? You can go to FortuneBuildersShow.com and get some more information about that. You can go to RealEstateIgnite.com and get some more information about Ignite specifically. I'm going to be teaching and sharing at Ignite, Gregg, how your company specifically helped my father turn one investment, right? One investment, $30,000, $40,000 down payment on a piece of property that I actually bought and I actually gifted to him a couple years down the road after I bought it. And that one piece of real estate is actually going to help him retire next year. Right. And it's amazing. And the life cycle and all the things we've taught and all the things we've done and how we took advantage of those for-profit centers, right? And how your company helped teach us what those for-profit centers were and how, there's some strategies we did to maximize those, which we can get into. And I've taught about on other podcasts. And again, if you want more information on some of those other strategies, you want more information on what Gregg's going to be talking about today, you want more one-on-one help, you want more of that mentoring and education and what Gregg's talking about, that's what we're here for, right? FortuneBuildersShow.com. Go there, put your information in, we'll reach out, we'll get you all that kind of information on that. So Gregg, I'm super happy. I'm super excited. I'm a living, walking testimony that my father's able to retire because of what we're about to talk about today. So I'm absolutely fired up for today's podcast. So let's get into it. Walk us through your definition, and we can even kind of compare definitions, which will be cool, and kind of debate it back and forth. What are, in your minds, the profit centers of real estate, right? And why are they important, right? So let's first kind of walk through a little structure. Let's name the profit center, kind of describe it, what it is, and then why do I care about it? Why do you care about it? Why did the person listening to the show care about that profit center kind of brass tacks? And then we'll move on to the next one.
Love it. Let's do that. I'm going to start a little bit even higher level with that. Why should we care about the 5 profit centers here in rental property investing compared to other places that you probably have your money?
Love it.
Because when I learned this lesson, I was like, oh my goodness. This other asset that everybody tells me I should be investing in doesn't have this. It doesn't have this. It doesn't have this.
Right.
It was like this huge epiphany for me. So I hope that elements of that happen for the audience here today. But in rental properties, you have these 5 profit centers, which I'm going to go through in detail. In the stock market, you generally have 1 profit center, maybe 2, maybe 2. Right? You generally have 1. And that profit center is stock price appreciation, right? You put in money in the stock market, you want to buy low and you want to sell high. That's stock market appreciation, right? And that's the 1 profit center that most people invest for. The other one, you may get a dividend, but it's certainly not going to change your life. It's, a very small number of companies actually provide dividends, and it's relatively small. So if you're in the stock market, you're investing for 1 profit center. Bonds are, generally have 1 to 2, maybe 3 profit centers, right? So bonds are all about income, right? So you have that income coming in on a month or usually on a semi-annual basis there. So you have that profit center. Depending on your bond strategy, you may try to get some bond price appreciation in there, although your upside there is very limited. So, and then there might be some tax advantage bonds, but it's not really why you're doing it. We're going to call it 1, maybe 2, but the overall upside is a lot lower in bonds. So that's usually how portfolios are created for investing and for individuals, right? It's 60% in the stock market, 40% in bonds, or somewhere around that allocation. So most of the investing public has 1, maybe 2 profit centers. Rental properties have 5. And so, Paul, do we think we need to go a little bit more into that, or do we just dive into the first?
I think the thing I'll add on top of that is part of why we do the show, part of what you believe in, part of what I believe in, is giving that education to people that I think the normal system in this country doesn't give people, right? Is hey, you go and you get a good job, and people listening to this podcast understand the other side of it. They understand how they're investing in themselves. They understand how they want to take control of their financial future. And education like that is vital. So I just want to take one more extra minute and scratch the surface on that. When Gregg talks about, share price appreciation, right? So that's typically what most Americans are taught and told is you take the money from your job, you put it into the stock market, and you're going to buy here, right? At X dollars. You're going to invest your 10 grand, 20 grand, 30 grand, 100 grand, whatever it is. And your portfolio is going to go like this over time. And hopefully at the end of it, when you need it, it's going to be up here, hopefully. Right. And so it's saying, hey, I bought it at this. It's now worth this. We're not talking that's 1 profit center. We're not talking any kind of, oh, by the way, every month you get a check. We're not talking about anything else other than hey, usually, and that's what Gregg's talking about, 1 profit center most of the paper-based assets, stocks and bonds and all that kind of stuff, are usually buy it here and hope it's here by the time you need it, whenever you do need it, right? Takes them out to pay for college, takes them out to pay for healthcare, takes them out to retire, right? What we're going to be talking about today is, well, you can get that plus all these other things, right? So I just want to kind of break that down. This is very much kind of considered alternative investing because most people don't have this education, right? And that's why I'm so excited about it. So yes, Greg, dive into it. Okay. So the 5 of real estate are what?
Well, number one, we're going to start with net rental income, which is also known as positive cash flow. Net rental income is a beautiful thing. It's also misunderstood how important it is, though, which we'll get into in just a second. But net rental income means that, these rental properties are providing shelter. They're providing housing for a family out there. So there's rent that's coming in. So you got your gross rental income. You take out all of the expenses that happen on a normal month, right? That might be your principal interest payments, your property taxes, your insurance costs, property management fees, and things of that nature. And what you're left with after all that stuff is taken out is your net rental income. That's your positive cash flow. Now, the reason that this is important is because we want to invest in assets, not liabilities. Assets, not liabilities. And there's a few different definitions of what makes an asset and a different liability different. And you're talking to a CPA, it might be something else. I'm just a realist. I'm just a real estate investor who owns over 300 rental properties. Here's my definition, which is it paying me every single month, or do I have to pay out for it every single month? Right. And if you want to achieve scale, if you want to own a portfolio of rental properties, I guarantee you want assets that are paying for themselves every single month. And if they can break even and do a little bit better than that positive cash flow, that is what you want, right? You don't want the opposite, which is going $300, $500, $1,000 in the whole negative every single month to make your house payment. And that's one big mistake that people make when it comes to positive cash flow.
Yeah. So, and explain this, because this is what I talk about in a lot of my education. And I want to make sure we drive this home is most real estate investments, they don't even explore past net rental income. They don't even show, hey, anything else. They just focus this. And most investors, right, that I've found who don't have the kind of education that Fortune Builders provides, is they don't even understand, right, that they're comparing oranges to apples, or oranges to steak, right? Not even in the same food group, right? What they're saying is they're just focused on the cash flow from the rental property. Hey, the rents are coming in. I've got these expenses, my mortgage, everything you talked about, property management fees, taxes, insurance, all that stuff. I'm left with $50 a month, $100 a month, $200 a month, whatever it may be. And then they stop there, right? And that is a vital piece of the equation. But what they're doing, remember our situation earlier when we're comparing it against like the stock market, they're taking that one profit center, and maybe it's a 2% to 5% to 6, 10%, whatever the percentage return is. They're taking that against the stock market. We're comparing basically dividend income, right? One source of income compared to stock price appreciation. And like that is comparing, math to English. They're two different subjects, right?
Love that.
Right. And so it's important to say like, yes, hey, your cash flow is super important. It's one part of the whole puzzle. And so when you are presented with an investment opportunity, make sure you don't just stop there. Make sure the company you're working with, or the real estate agent you're working with, or when you're doing your own analysis, right? And again, we have tools to help you with all those analysis pieces that go way beyond there. They calculate all 4, be able to compare apples to apples, which is important, right? So, if you're comparing, Greg, in your opinion, the cash flow, what would that compare to from real estate versus like a stock or a bond? What profit center is comparable, right, to cash flow?
It's a great point, right? I love how we need to compare apples to apples here. So in real estate, we call it positive cash flow. In the stock market, we call it a dividend.
Exactly.
And very few companies have dividends. And if they have dividends, largely they're like 1% or maybe 2%.
Exactly.
Which, you're not investing in the stock market for dividends, right? You're not investing for 1% returns. in rental properties, you're not investing for cash flow to be the end all be all. That's not the only reason to invest. So it's a really great point that you made there, Paul.
Yeah. And that's actually what, if you remember, our term of the week last time was investment objectives for that exact reason. What Gregg just talked about, right? Is what is your investment objective, and understand the different profit centers. So then you can match your investment objective to which profit centers make the most sense for you. So, all right, love it. Let's move on, Gregg, for the sake of time. We did one is positive cash flow, right? What's profit center number 2, sir?
Profit center number 2 is tax savings. And just by investing in rental properties, you have the ability to get these incredible tax savings that you don't have to have a special license for. You don't have to be an accredited investor. You don't have to have a certain amount of your work based in a certain field to get these tax savings. You get it, and it's built in with the investment. And these tax savings that you get from owning rental properties are so much more advantaged and better than what you get in the stock market or in bonds. You just don't get these types of tax savings. And specifically what I'm talking about is you get to write off a ton of stuff when you own rental properties. Tax time for me is a really fun time because I see all of the write-offs that I get from all the rental properties that I own, right? You're able to write off the interest that you pay on your loan. You're able to write off your property management fees or any maintenance costs. You're able to write off your insurance costs. I can go on and on and on and on and on. Right? Clients who come and visit their properties in Jacksonville, they live all over the country, right? In California, New York, they come to Jacksonville, they meet with their property manager, they do what they need to do to make sure that they're managing their assets, and then they go have fun and have a family trip. And, part of that is written off for them as the travel expenses, right? And, so there's all these write-offs that you can do, but there's one write-off that stands out that is just so incredible. And the thing that I think most people don't realize is when we talk about write-offs, Paul, most people like the idea of write-offs, right? If you're like, hey,
they like them. I don't think they really understand what they are, but I think they like them.
Right? We all like write-offs. We don't know exactly what they mean, but we're like, give me more of those write-offs.
Exactly. I want to pay less taxes. Okay, let's go.
Yeah. Well, with the write-off, what you actually have to do is you spend the money.
Right.
And then you get to write it off on your taxes. So yeah, we all love write-offs because we get to adjust our income that we have to pay taxes on it. But the downside of a write-off is that you actually have to spend the money, right?
Yep.
What if you could have a write-off that you didn't actually have to spend the money? How much more would we all love?
I'm on board. I'm on board.
Well, in rental properties, we get that, and it's called depreciation. Depreciation from a tax perspective. I'm not talking about the market value of the property here. I'm talking about depreciation. And the depreciation, and I'm not a CPA, so go and talk to your CPAs. I'm just giving you the realness right now. Depreciation to me is a non-cash write-off, which means that I didn't actually have to spend the money, but I get to reduce my taxable income. And we'll keep it really simple here. Basically, the IRS says that, listen, over a long period of time, things are going to break in your property, and we're going to let you write some of that off every single year, even if things didn't actually break. And so what this means for you is that you get to keep more of your income that you earn with rental properties, and you get to write off using depreciation plus all these other write-offs so that you get to keep more of your money. If you made the same amount of money in stock gains, you would pay a lot more in taxes than you do when it comes to rental properties. And so tax savings are a huge component of why savvy and wealthy investors love hard assets like rental properties.
Yeah, it's been one of the kind of quote unquote secrets of the rich, right? Or secrets of the wealthy for a long time is, why do so many of the wealthiest people in the world own so much real estate, put so much of their money in real estate? Is exactly what you just talked about, right? It's seen as, yes, it has predictable income, like we talked about in profit center number 1, but profit center number 2, it provides a whole litany of benefits on the tax side, which you just talked about. And how many of you listening, I'm going to break the third wall a little bit here, Gregg. How many of you at home either spit out your coffee, chuckled, or did a what when Gregg said that he loved tax time, right? How many of you have that experience where Gregg loves tax time? You're like, huh? What did this man just say? Because that's not the case for most Americans. Now, most savvy investors who have the education that we're talking about and make the right decisions and build a portfolio of real estate right? Whether they're starting at the very beginning or they're putting a lot of their wealth into it at the end. Either way, you get to take the same advantages in either stage of your career when you can take advantage of some of the stuff that we're talking about. Whereas if you go down the traditional path, tax time sucks,
Yeah.
right? It just sucks because that's more money out your pocket, right?
Yep.
Or hopefully your company took enough out of your pocket already and you
Right.
get a little bit of a refund at the end of the year, right? And,
Yeah.
so tax time is very different for investors versus kind of the normal W-2 type world, right? For sure. All right, Greg, love that. Number three.
Number three, principal pay down. So principal pay down is this beautiful experience, again, where you've got a loan out there, right? You took out a loan to buy the property. You learned about how to use other people's money, right? You use how to use smart debt. You learn how to use smart debt. You've got a loan out there. And rather than you having to pay your own loan back, there's another beautiful family out there that is just saying, listen, let me just take that loan off your back for you. Let me pay down your loan for you. Like, I remember when I had loans, especially student debt. I know a lot of us have that. Like,
yeah,
like our entire economy right now is saying to ourselves, listen, how awesome would it be if somebody would just come over and just forgive all of our student debt, right? Well,
yep.
And whatever your thoughts are on that, I'm not here to judge, but what I'm saying is like, you have something like that built in to rental property investing, and it's called principal pay down. So when you take out a loan and you rent that home out, and that resident is paying rent to you, a portion of the rent that they are paying for you goes to pay down your principal every single month for you. And it might not change your life today, but I've been investing for 17 years. This is the beauty about rental property investing. When you buy and you hold for a long time, all of these profit centers make a monumental impact years down the road. And so after 17 years, I look at some of my loans and some of them are completely paid off. And some of them have been paid down 50%. Some of them have been paid down 75%. And that didn't come from my pocket. It became because I made a smart decision to invest in rental properties, and I provided a great experience for a resident out there to rent the property. And they did a great thing for me by paying my loan off. And so again, in the stock market or in bonds, you don't have the ability to take advantage of smart debt. So you don't have debt pay down or principal pay down happening for you. But that's what you have in rental properties. That's the third profit center.
Yeah, and this one is huge, right? And this is one that I always say, two massive forces in the world. If you can combine them in this particular case, it's a beautiful thing, right? You have leverage and you have time, and you mash those two together. Holy moly! If you can defer some gratification, not live in, we live in an instant gratification society. We're all on our, smartphones all the time because we want instant gratification. If we can try slow for a little bit, right? And make a smart investment decision, not just for today, right? The today profit center is the cash flow, like we talked about, right? And I've talked about this on other shows. The today instant gratification is, okay, what's my return right now? Cool, great. I'm getting some cash flow. Awesome. But my tomorrow and down the road profit centers, now those are the ones we're getting into now. If we can embrace that and love that deferred gratification, that's where the real wealth is created. And my father's a great example of that. You're going to show some great examples, hopefully, of that, I believe, in some of your case studies, right, Greg?
Sure.
I'm going to tease those a little bit. It's phenomenal when you take, okay, every month I'm taking the, $1,000 I'm getting, or $1,500 I'm getting, or whatever it is in total from the rents, and I'm paying my mortgage off with some of that, right? Not my money, like you talked about, Greg. The renters, that beautiful family that's in there, that we're providing the service for them, we're providing housing for them. It's phenomenal. That happy family paying us for that. We take a portion of that, pay down our debt. You do that over time, and you look at the amortization tables and you look at the math, which again, I hated math until it started making me a whole lot of money, right? I'm not a math guy. Let's keep it real simple. We pay the bank down, right? Over time, that's where you can unlock, with this other profit center we're about to talk about, the next one, I'm assuming, Greg, I'm going to tease it, the appreciation of the asset as well, too. You take that beautiful mixture where you leveraged into it, you allow time to happen. All of a sudden, you've created this massive amount of equity, which is wealth, right? And we have these other strategies that we can teach you, Fortune Builders, of how to tap into that, how to refinance and take cash out and do all these awesome things to tap into that. And frankly, that's how my dad is able to retire, is
Yeah.
this exact profit center right now, is paying down that principal over time. And the next profit center, Greg, I'll let you go ahead and talk about it now,
Yeah.
in combination with it, right, has allowed him to retire. It's beautiful.
It's a beautiful thing. Many people don't realize that even if your homes don't appreciate, you are building equity by your resident paying it down for you. That's what principal pay down is for you. But that's a good segue into what happens if your homes do appreciate. That's the fourth profit center, and that's home price appreciation.
Yep.
And, you know, home price appreciation is one of the most misunderstood profit centers.
Totally.
You know, from before 2006, everybody thought home price appreciation happened all day, every day, and twice on Sunday. Like home values never went down. That's what people thought.
Yep.
And then, you know, in 2007 and 8 and 9 and 10 and 11, people realized that, guess what? That's not really how it works. This is an investment, and that things don't always go up. And so what's happened since the Great Recession, which I just described, is that there's this common theme between investors right now where they say, listen, I was burned in the Great Recession. And so because of that, I'm not going to count on home price appreciation at all, right? The last 2 years, we've seen 25% home price appreciation year over year. So clearly it's a thing, like clearly it happens, but people are saying, I'm not going to count on that at all because I don't know if it's going to be here in the future. And the thing that is a shame about that is because if you actually look at the data, home prices and home price appreciation is predictable, just like stock market cycles are predictable. Right now, people have lost 25% in the S&P 500. And they're still saying, listen, I'm going to keep my money in there because I know it's going to come back. What they're saying is that they believe that it's cyclical, that the stock market is going to come back. Well, in real estate, if you actually look at the data, you go 40 years back and you see what average home price appreciation rates have been as home values have gone up, even as they went down during the Great Recession, have gone back up again, what you'd find is that there is a similar cyclical approach to home price appreciation. And this is a really critical component. If there's one takeaway from this call, it's understanding how impactful home price appreciation is and when you can count on it. Because the when is important. If you are investing for a full market cycle, and that's why I advise buying and holding for a full market cycle, then you can count on home price appreciation because it repeats itself every 10 to 20 year cycle. If you're not, if you're investing for 1 year, 2 years, 3 years, you shouldn't count on it, right? But the most successful rental property investors do invest in a buy and hold strategy for a 10 and 20 year cycle. And that's why when you're looking at a market that you could be investing in, understanding what that market has done historically over the past 40 years will give you the answers to the test if you're asked, what is my market likely to appreciate over the next 10 to 20 years? So that's home price appreciation. It's often misunderstood, but if you understand the concept that it's cyclical and that it repeats itself, you can then make a better decision on which market to invest in. Because there are some markets that have appreciated 4% on average over the last 40 years. There are some that have appreciated 3%, some less. And while that might only sound like 1% or 2% of difference there, that 1% equates into hundreds of thousands of dollars in additional value by choosing the market that has appreciated more over a 10 or a 20 year hold. And then multiply that times owning 5 of those properties or 10 of those properties. It literally is $1 million decision. And it's all based in this really deep understanding of home price appreciation. So Paul, I know I get on my soapbox talking about home price appreciation.
I love it.
What should we dive into a little bit more there?
Well, it's super important because now what we've done is we've explained 4 of the 5 profit centers. Okay. And now we can get a little bit of the conversation of apples to apples finally, right? So we started with this of, hey, we've got, an apple over here and a steak or a soccer ball over here, whatever, right? We've got 2 totally different things and totally different conversations of, the stock market and real estate, right? So because the stock market has 1 or 2, profit centers, it has appreciation, which we just talked about. And sometimes it has a dividend, very small percentage, but it has a little bit of a dividend, right? Well, now we've explained 4 of the 5 profit centers where we have, right, the dividends, AKA cash flow. We have the same share price appreciation, aka the value of your home going up and or down over time, right? But then we have the other two profit centers. So on average, I've seen, right, on the real estate side, when you combine all four of those profit centers, you're easily in the double digits, easily, right? And we have calculators and we have tools and we have things that show how to do these calculations, right? Because, there's some math involved. And again, I didn't get good at math until it started making me money. So I built a tool that did the math for me, right? And again, you want more information on like, how do you get those tools? FortuneBuildersShow.com, put your information and we'll walk you through all that stuff. We have tools on how to analyze deals and tools how to analyze this math that we're talking about now, so you can apply it to your own portfolio. But Greg, are you seeing the same thing I'm seeing? I'm seeing when you combine those four profit centers in real estate, I can easily show how most pieces of investment real estate, that good areas, good solid markets, good solid, quality neighborhoods are easily double digits, sometimes, 10 to 20% type returns is what I'm seeing right now. Everyone's different. Everyone's going to have their own returns and metrics and everything. But are you seeing the same thing compared to the stock market historically on a 7 or 8% just off share price appreciation over a 20-year period?
100%. At the end of the day, the reason why I quit my job and I started out to build my own income producing army of over 300 rental properties, and I built an entire business, is because of what you just accentuated there. It's because you can earn substantially better returns by owning rental properties, and you can mitigate risk at the same time. Remember, I'm conservative. Like, I like the fact that my assets pay for themselves every single month and I have some income coming in every single month. And so when I look at any asset out there, I'm like, is there bigger upside and less volatility? I'm seriously interested.
Right.
And you just went through my thought process as I was not liking my job in corporate America and thinking what to do next. I mean, and it was go hard or go home. And that's where we are 17 years later.
I love it. I love it. All right, man, let's hit the fifth profit center. And if you have some time, I'd love to get into a case study or two if we have some time.
Absolutely. So the fifth profit center, the hidden profit center that not enough people know about or talk about, is inflation hedging. And prior to the last year, inflation hedging, what I would say that people were like, I don't even understand what the word inflation means. We've all unfortunately had a very big indoctrination as to what inflation is and how it can really hurt us as a country and how it can really hurt us as investors, because all inflation is, at the end of the day, it's another form of a tax, right? As the cost of things go up around us, the value of the income that we have becomes less. And so if we can have an asset that hedges against inflation, then that's a really good thing, right? You don't see inflation hedging in the stock market, right? You see inflation hedging in hard assets. And so what do I mean by this? This means that if you look historically, again, over the last 40 years, there's a reason why rent prices tend to appreciate and home prices tend to appreciate at roughly the same rate as inflation. And it's because the cost of goods and services around housing go up so that home prices and home rents tend to go up in lockstep, because that's what it costs to produce a hard asset. So and this is why, and real estate investors, our clients, right? Paul, your dad, the Fortune Builders team who owns properties with JWB, myself, right? Inflation is not fun overall, but when we look at our investments, all of our rents have gone way up. All of our home prices have gone way up. This is not a phenomenon. Like, this is planned and expected. And so you can invest in an asset that has inflation hedging built in and be in the driver's seat. Again, risk mitigation is really important to me. And that is a huge component here.
Yeah. It's also why we're seeing, massive institutions in the last 24 months. Blackstone made a multi-billion dollar, with a B, $billion bet and investment into hard real estate assets, single family homes, actually, right? I think they bought $7 billion, if my memory serves me right, of single family homes. And this was before, because they have access to a whole bunch of data and a whole bunch of research and got a whole bunch of people who are super smart. They saw what was coming. Probably they saw, okay, wow, inflation is running rampant. Let's have a hedge against probably what's coming. And smart investors, I talked about it at Ignite last year, was, hey, this just happened. why. And one of it was exactly what you talked about is, well, it's almost a defensive strategy, but it's a defensive strategy, like you said, to mitigate risk. Let me put my money into hard assets that are going to help me not have to deal with and have the pain of inflation, right? Just like you said. But also I get these 4 other profit centers on top of that as well, too, that beats often all these other investments. All of a sudden it becomes a no-brainer. We're seeing why the wealthiest people in the world have either made their money or put their money into real estate, right? And that's exactly what the show is all about. It's helping teach you why. Everyone says that, but not many people understand the why. And that's what you just covered, which I love, Greg. So thank you. So in the couple minutes that we have left, I would love to see, I'm curious. I always love to see case studies because it's a real live example of what happens. Do you have a couple of case studies you can share with us in a couple minutes here that kind of bring this point home in some actual portfolios, Greg?
I got you, buddy. I am going to bring that up right now as I fiddle around with all the screen sharing and, do my best to be the Vanna White of our production here.
All I'm missing is this from you. I'm just missing a little bit. I'm just missing a little bit of, the theme music and the hands and, touching the screen to make the letters go round and round. But other than that, it's great.
I'll work on that. All right. So there are 5 profit centers: net rental income, tax savings, principal pay down, home price appreciation, and inflation hedging. To wrap this all up, there are 5 of these. The other places that the traditional, call it average investors out there, only get 1 to 2 of them. And when you wrap all of these up, you make 20 to 30% higher rates of growth in rental properties consistently, like cycle after cycle, 20 to 30% better returns in the stock market. And you have consistency, which right now, people are craving consistency if you've been in the stock market.
Yeah.
Right. It has been extremely volatile. And if you don't like to ride the roller coaster, these profit centers also mitigate that risk. They provide that for you. So let me show you this. All right. This is an actual property that I bought back in 2007. It was one of my very first purchases. The home on Scotton Road here in Jacksonville. Bought it October 5th of 2007. I bought it for $125,000. It's a 3-bedroom, 2-bath home, right? Really, just nothing too crazy great about this home. It's just a decent home in a decent neighborhood. And that's what we want to invest in, right? And workforce housing and things of that nature, right? It's built in 1941, right? Let's look beyond what the picture looks like here. That's a really important part of how we make decisions as investors here. And let me talk to you about what I have experienced through these 5 profit centers in an actual asset. And I still own this house today, by the way. Let's first take just a glimpse at when I bought this house. Okay, I'm showing you here a snippet of home prices in Jacksonville, Florida. And you're seeing the blue line is actual home prices each and every single month. And the red line there is just the average trend line. And so what you're seeing here is an actual bubble that showed up in 2006, right? And then eventually afterwards, home prices came down in the Great Recession. Well, Paul, if people aren't actually watching this video right now, I circled when JWB bought Scotton Road. Where would you say I bought that property at the best time to buy or maybe the worst time to buy?
Well, I know the end result, but I would definitely say you bought it at the height before the fall, my friends.
That's
the
right.
Natural cycle, right? At the height of the cycle, before the natural downturn of the cycle started, before the next upcycle, right? You definitely bought it at the height, my friends.
Exactly. If you could have chosen the wrong time to invest in a rental property in the last 20 plus years, this would have been October 5th, 2007, which is when I bought this property. So keep this in mind. All right. Here is a very big takeaway. You remember just earlier on in the call here, we were talking about how home price appreciation is cyclical. Well, I went back and I pulled home price appreciation rates on average if you bought a property in the last 10 years, if you bought that property 15 years ago, which I did in 2007, or if you bought that property 20 years ago. Your initial median sales price, your current median sales price based on what the median sales price is for the market right now, and your average home price appreciation per year. What you see over the last 10 years is probably what you expected. We appreciated at a rate of 9.4% per year on average in Jacksonville. But what you might not expect is that even though I bought the property at the exact wrong time, in most people's opinion, the average home price appreciation rate, if you bought in 2007, is 4.1% per year. All right. If you bought it 20 years ago, it was 5.2% per year we've appreciated. So the big takeaway here is if you go all the way back since 1982, and you knew that you had 40 years of data that said that you were going to have a certain home price appreciation, right? Let's say that that rate is 4.6%, because that's actually what the home price appreciation rate is in Jacksonville, Florida, over those 40 years. I could have told you at 10 years down the road, 20 years down the road, 30 years down the road, within about a point of the home price, I could have guessed what home price appreciation would be. And it's because I understand how market cycles work, right? 4.1% is not that far different than 4.6%, which is the average of how our market has appreciated if you invest for the long haul. Paul, how are we doing there? That's a pretty big concept.
I think the thing is people are surprised, right, when they see headlines. Oh, inflation's coming. Oh, the stock market lost. Well, the stock market loses half its value once every decade, right? That happens. That's happened for a long time, right?
Absolutely.
Real estate, and so then when real estate has a cycle, right, and they have the news, oh, real estate's going up, real estate's going up, real estate's going up, and then all of a sudden it's a shock to people. Oh, real estate's going down for a little bit, and the world is falling.
Mm-hmm.
It's important. I always say perspective is a gift. Perspective is a gift. I love perspective. And that's what this is having better information often than the next guy or gal and being able to act on that information. That's perspective to me, right? So this is huge perspective. Hey guys, this is predictable. This is something we can calculate. This is something we can count on. When you remove yourself from the instant gratification that we're trained to have, oh, I don't want to invest in something right now because I'm reading this headline. That's an instant gratification versus a perspective approach. Hey, let's take some data over a long period of time and let's look at it and make a smarter investment decision, right?
100%. 100%, man. It's like knowing the answers to the test. That's what I say.
Yeah, I
want to know how much this market's going to appreciate, or your market, how much it's going to appreciate over the next 10 to 20 years. I could tell you, I'd be within about a point of what it's going to appreciate.
Exactly.
So if you know that, use that to your advantage and choose the right market.
Exactly.
So this is my breakdown of all 5 profit centers on a property that I actually still own today, right? $37,000 of net rental income. Do you get net rental income in the stock market typically, Shively?
Not usually. If you do, it's a whole lot less than that.
Absolutely, man. 37 grand that my residents have paid me. That's an asset, right? And this is available. This is what we do at JWB. We provide assets that provide positive cash flow, right? Tax savings. Wow. There's been 6 grand of taxes that I've saved all along the way, right? Listen, that's 6 grand of taxes. That's not going to change your life all by itself, but that's 6 grand of tax savings you don't get in the stock market, right? So another big advantage there. Principal pay down. Oh my goodness, $26,000 of my loan has been paid down by my resident. You wonder why JWB, we love serving our residents. We want to create incredible client relationships with our residents. Well, we do that because that's the way we conduct our business. But we also do this because these residents provide a tremendous amount of value for our clients, right? For every client out there, it might be $26,000, it might be $50,000, it might be $75,000 of loans that their residents have paid down for them. So not only is it the right way to treat people, you also have a huge financial reason to make sure that your resident is happy with you and staying in your home a long time. Home price appreciation is really important to talk about. Again, I bought this in 2007 at the height of the bubble, but I still have seen $115,000 in home price appreciation. Again, you couldn't have picked a worse time for me to buy this thing. But when you buy and hold in rental properties and you invest in turnkey assets that pay for themselves, you're going to win if you buy and hold for a long time. That's just the way it goes. Inflation hedging, our current CPI, our current consumer price index, according to the government, is 8.3%. That is incredibly high and unfortunately not coming down as quickly as we all would like. Well, for me, my rents have gone up tremendously. Of course, home prices have gone up tremendously. So I don't like inflation for our overall economy, but for my investment, listen, I have that hedge built in. When you look at the total return on investment, my money has performed at a 17% return year over year over year over year over year. And this has happened while the Great Recession happened, while we survived a pandemic, right? While we have all of these things going on in the world right now, my money is earning 17% year over year over year over year. And I chose the exact wrong time to do it. So when we talk about how you can earn much better returns by investing in rental properties and mitigate the risk, right? Have 30-something grand coming in over a 15-year period, like this is what we're talking about. Been able to live it, and it's something that I love helping other clients do for themselves as well.
Yeah, absolutely. And of course, everyone's results are going to be slightly different, right? This is one property, one case study. But what we're trying to drive home here is when you have the education, when you have the knowledge, when you have everything that we talked about today, this is the kind of the results that you can expect, right? This is real life, real world examples. That when you apply those 5 profit centers, I even said 4, Greg, because I'm so ingrained to say 4, there's 5, right? When you apply the 5 profit centers and you make decisions based off of those, this can be the net result, right? And your results may be a little bit lower, a little bit higher, a little bit different, of course, right? But drive home the point of this is what the education, the net result is when you implement it, right, Greg?
Absolutely, brother.
Yep.
So we're going to round out with a couple key takeaways here. This is what I want you to leave with, right? Here's my breakdown of my total returns by profit center. Okay. Most investors, when they're thinking about buying rental properties, they only focus on rental income. That's that positive cash flow. And if the positive cash flow might be $20 less than they want, or $50 less than they want, or whatnot, they might say, listen, I'm not going to invest in that market, or I'm not going to invest in that property, or I'm not going to invest with that provider. They put so much of an emphasis on such low dollar values for net rental income or positive cash flow. But if you look at the overall return, how am I, as your asset manager, going to deliver a better return on investment for your money? That is one of the smaller pieces of the pie, right? The bigger piece of the pie is home price appreciation, right? 62.5% of my overall return on investment comes from home price appreciation. So we need to understand all 5 profit centers, right? There's tax savings and there's principal pay down, which is roughly 17% of my overall pie here. And that's basically the same as what rental income is. Yet everybody just talks about rental income and nobody talks about principal pay down and tax savings, right? We collectively as rental property investors are missing the mark of where to make our decisions. Because at the end of the day, if you're like me and you own these properties for 10 years, 15 years, 20 years, you're going to look back, you're going to wish you chose a market that actually grows more. You're going to focus, you want cash flow for sure. It's important, right? We want assets, not liabilities, but we're not going to keep cash flow blinders on. We're going to expand our horizons to understanding not just what positive cash flow it can provide, but what market historically has grown more than another, because that fact alone will lead to hundreds of thousands of dollars more for your overall portfolio, depending on the number of properties that you have. And one last thing, I know we're wrapping up here, is you may say that this is different because you invested in 2007. What I want to show you is I have the benefit of, there's 1,300 clients that we manage. They've purchased over 2,800 properties with us at JWB. And I know all of their returns because we report on all of those returns. So I just randomly chose different clients to see what their overall pies look like. All right. And this is a client that bought in 2019 in the top left, and a client that bought in 2016, and a client that bought in 2012, and a client at 2007 purchased. Paul, what do you notice about these pies?
I'm not the smartest guy in the world, but that looks like a lot of green, my friends.
A lot of green, right? 2,800 properties that we analyze. Every single client's portfolio, if they hold on for a long period of time, looks like this. The biggest portion of the pie is home price appreciation. The biggest piece of the pie is home price appreciation. So if you're just writing off home price appreciation because you were burned in the Great Recession, I understand, but that's costing you money.
Amen.
It's costing you money.
Amen. And it's funny because I made the same exact decision in my own evolution as an investor, right? You know, I've now done over $2 billion worth of transactions, right? And I've helped over 6,000 families build their portfolios, right, at Fortune Builders. And, you know, even at the beginning, and this is why I think this podcast and this show is so important, because don't make the same mistake I did. I wrote off home price appreciation for years. I made horrible decisions, not horrible decisions. I still invested in real estate, but I left money on the table, I should say. I didn't make the smartest decision because I wasn't looking at all the data. And my own maturity and evolution as an investor myself has grown. And that's exactly why we're doing this, to show you, hey, take all 5 profit centers into account. I love it what you said, Greg. Don't just put your cash flow blinders on, because you're going to end up making an investment decision that's not in conjunction or with the perspective that we talked about, right? Which is huge. So Greg, to wrap this up for all of our mastery students on the call, how do they get in touch with you and your team to start to do this in their own portfolio?
Well, we love our relationship with the Mastery Program. I can't wait to get to Fortune Builders Ignite as well. I'll be right there with you, buddy. And so hopefully we get to meet all of you there as well. But you should start the conversation with us. If you're interested, if this resonates with you, if it's something you'd like to add to your portfolio, we are here to help. The best thing to do is to go to jwbpassiveincome.com, jwbpassiveincome.com, and start the conversation with our team. And then if you would like to follow me a little bit more, and I do a show every Tuesday and Thursday, we have a podcast, and it's called the Not Your Average Investor Show. If you'd like to join us in the live audience and be a part of 50 or 100 other investors that join us each and every show. In fact, I'm about to leave this podcast and jump onto the show here in just a couple of minutes. You can register at jwbshow.com and join the fun. So Paul, brother, it's been a real pleasure, man. Thank you for having me.
Thank you so much for having us, Greg, join you for the last hour or so. Loved it, my friend. I know I learned a ton. I know our team learned a ton as well, too. All of everyone listening to this podcast, I want to say thank you so much. And I'll sign off this way, as always. Thanks for joining us today. And if you can, don't just take care of yourself in today's world. Try to take care of at least one other person along with you. That's a wrap for us today. Thank you so much for joining us on Fortune Builders Real Estate Investing Show. As your host, Paul Shively, signing off. Take care.